Hey there, everyone. Dave Keller here with Market Misbehavior. It's Thursday, July 2nd. I am scrambling, ladies and gentlemen, and I will be honest with you. I'm not going to pretend that this was not a crazy, hairy day. Let me tell you what happened. I am in Redmond, Washington, downtown Redmond, Washington, meeting my good friend Grayson Rose of stockcharts.com. We met for lunch. We had a lot of really fun conversations. We have some really cool plans for some really cool things going on. Unfortunately, I can't share any of those details with you, but I will tell you we're looking for a fall launch for some fun things, partnering together. And as soon as I can share some details with you, I will. But it did completely torpedo my attempt to start this live stream at 2 o'clock promptly local time here. And so I'm scrambling literally as we're going live. I'm getting the last chart into my chart list. So apologies for the late kickoff. I appreciate you hanging with me. I promise that it is for a good reason, and awesome to reconnect with my friends here at Stock Charts headquarters. And hope you guys are all doing well wherever you're at. Awesome match last night. Not so awesome red card. I would agree with you talking about the red card on Balogun. Man, total. I think that's a miss. And it's one of those things where the freeze frame approach to what they call the VAR, right? The review is just brutal because it makes things look a lot worse and more intentional than they probably were in person. So tough loss to have basically our top goal scorer out for a showdown with Belgium in Monday in Seattle, Washington. So that's awesome. But hey, awesome win. We'll take it. We'll continue on. This World Cup has been really cool. Those of you that are soccer fans are probably absolutely loving it as I am. Those of you that are not, I hope you find some joy and inspiration from lots of people from around the world cheering on their teams and some good moments for the U.S. team as well. Talk about the markets. I mean, sort of three different periods just during the trading day today, right? Strong move out of the open to the upside. Big disaster midday from around 11 a.m., really 10 a.m. Eastern to around 2 p.m. Eastern. Just a complete give back. So it looked like the S&P was going to log a huge down day going into this long holiday weekend. But then this beautiful recovery in the afternoon, popping the S&P back to literally almost exactly yesterday's close. And when I say almost exactly, I mean, this is as close to unch as you can possibly imagine. We were literally zero point 0.01 S&P points away from yesterday's close. So rounding to 0.00%, that's how much of a change there was in the S&P today. There was literally nothing. What we will do today is talk about these market conditions and how we finished off the last trading day of this week. As a reminder, tomorrow, of course, U.S. markets are closed for the Independence Day holiday. Happy early 4th of July to all of you who celebrate here in the U.S. We are planning a show for tomorrow. Markets are going to be closed, but we found those market close Fridays are pretty good days for a mailbag episode. I've gotten some really good questions from you guys in the last week. Already grabbed a number of them to feature, but happy to take a couple more questions anytime you're ready. So if you're tuning in live, thank you for hanging in there until I was ready to get this kicked off. Please, if you're watching live, drop questions all along the way on the comments section on Facebook, LinkedIn, YouTube, and X. If you're watching the show later on our YouTube channel, thanks for tuning in and just use the comments section there. A couple of questions I'm going to feature tomorrow came from just comments on our YouTube channel. I thought were really thoughtful questions that I'd love to dig into a little bit further. Let's talk about the market conditions today. The S&P, with all of that flipping and switching up a bit, down a bit, back to up a bit, ended up literally unchanged. 74.83 and a quarter is basically the close for the S&P. So obviously still well above our line in the sand, still holding, that key level of support that we've laid out. A break below that support level, as we'll see on the chart of the S&P 500, could be climactically negative, but it's not there yet. We're seeing buyers coming in on any short-term weakness here, which is encouraging, I think. Breadth pretty good today as well, as we'll get to in a minute. The NASDAQ, though, not nearly as good. Opened pretty strong, but then for the remainder of the day, really deteriorated. So the growthy stuff struggling the most, and mega cap growth really the worst place to be today. The Nasdaq 100 was down 1.6%. So look at that. The Nasdaq 100 down 1.6%. The Nasdaq Composite down 0.8%. That's how it's kind of like comparing the equal weighted S&P to the cap weighted S&P, or the S&P 1500 to the S&P 100, right? And so there's this big gap between mega cap growth, which did not do well today, and the rest of growth, which did slightly less poorly, I would say. You'll also note the VIX ended up being pretty low. At one point, it spiked above 17, but in a familiar pattern we've been documenting here recently, volatility really remaining relatively low. So while this feels like a choppy market environment, and while it feels like particular areas of the market, things like Micron, which I know a number of people have mentioned, and other names having some wild swings, the major indexes really are not having that much volatility. The major indexes are seriously lukewarm at best. They are in kind of a choppy, sloppy, sideways mode. But volatility remaining very low. So that basically says the movement, the volatility, the uncertainty is down at the stock level, right? It's at the group level. It's something like semiconductors with the big movements. It's not at the index level, which is, these big moves are netting out to indexes that aren't changing a whole lot. Interest rates kind of mixed today, but the 10-year and long bond yields did drift a little bit higher. 10-year yields just below 4.5% going into the holiday weekend. The long bond yield remains just below 5%. Honestly, there wasn't a big day in the fixed income markets, I would say, in terms of changes. Where there was a big shift was in the dollar. The dollar index was actually down pretty good today. Bit of a downside reversal. You can see the UUP, which is a bullish dollar ETF, finished down about 0.5%. We'll look at the chart of the dollar. I believe I grabbed that one. I was rapid fire, like lightning round style, grabbing charts that I knew I wanted to show. But pretty sure I grabbed that one. Gold and silver, pretty good days. I saw someone, and I won't answer your question too much, but gold still in a downtrend, right? Up 2.25%, still below trend lines, still below the 200-day moving average. I think that is still guilty until proven innocent. But nice to see a finish to the week where gold and silver kind of shifting away from being fairly highly correlated to the S&P and the Nasdaq, and actually moving higher on a day when growth and certainly large cap growth were down quite a bit. Crude oil was basically flat today, right? The WTI crude oil actually had a nice rally in the afternoon to finish basically flat for the day, as did Brent crude, as did nat gas and gasoline futures. Cryptocurrencies generally pretty constructive here. We can see Bitcoin's been drifting higher over the last 2 days. Yesterday, we were talking about Bitcoin around 60,000. Right now, it's just below 61,500. So decent recovery there. Ethereum price is up a little bit more, over 5.5%. Top 10 coins all in the green here. Interview just this week with the president of Cyber Hornet ETFs. I think that'll probably go out over the holiday weekend, to be honest with you. I've got a couple episodes with my editor who is grinding through some of these episodes, trying to get them out to you as quickly as possible. But really good discussion about sort of the short-term plays on crypto versus the long-term sort of value proposition. I'm excited for you to hear that one, because it was a pretty good discussion. I was really happy to go through some of those themes with him. All right, looking elsewhere, we can see that 8 out of the 11 S&P sectors finished in the green today, which is pretty strong. And that's one of the better days we've seen in terms of sector performance. Healthcare, utilities, and consumer staples. The bad news is those were the top 3 sectors. Now, is it bad that they were up a good amount? I mean, no. If you own healthcare stocks, it's actually pretty good. The problem is these are pretty defensive sectors. So what you see today and what's happened through the course of this week is, if you ask me, Dave, what's most likely to happen in sort of this quarter end week where you've got 2 days at the end of June and then 2 days to start July, and then we go off for the weekend, my guess would be you're going to see some growth recovery on day 1 and day 2 to finish off the quarter. This is I'm guessing money managers are wanting getting back to some of that exposure and showing that they're owning some of those top performing names. And then you're going to see those bets go right back off and rotate to other things. And that's really what we've seen here between Monday and Tuesday, which was growth over value and sectors like technology at the top of the leaderboard, to today, where you see tech down 2.7%. You see consumer discretionary, communication services, the 3 FANG sectors, the only ones in the red. Everything else going up today. And again, some of those defensive sectors actually having some pretty decent finishes to the week. We'll come back to the stock level breadth in a moment, but just to keep on that theme, right here, the 9 Morningstar style boxes: value, core, and growth. And then from the top, we've got large, mid, and small cap. Large cap value is the only one of these 9 buckets in the U.S. equity space that were up today. The only one, large cap value. All the growth indexes were down. All the small cap indexes were down. So this is really localized with one area of the market showing a decent amount of strength to finish the week. As a result, the breadth is kind of mixed. It's actually probably better than you would have expected in the S&P 500, where 71% of the S&P members were up today. 63% of the mid-cap index was up. At the broader New York Stock Exchange level, about 59% up to 38% down. That's not bad, but kind of mixed here, right? Depending on which area of the market you're looking at, the breadth was either pretty positive or kind of neutral to slightly negative for the NASDAQ composite. Excuse me. Breadth in the S&P, though, in the large cap space, pretty good today, and that tracks with what we're seeing with large cap value. So the S&P flat for the day, the breadth positive. That's because the large cap value is up. Large cap growth was down. Core in the middle is basically between those two. There's a lot more growth in terms of the weight, particularly at the larger end, but enough of the value stuff was doing just fine today. Looking at what we call Dave's Dirty Dozen, these mega cap growth stocks and some key ETFs, thinking about those themes. We've got Apple up 5%. I've read a lot of articles sort of lamenting on the jacked up prices for Apple products. Phones, it looks like, are holding relatively stable, but any sort of tablet like an iPad or any MacBook Pros are all becoming way more expensive just overnight. So that is something that investors are dealing with. Certainly consumers going to be dealing with. For today, Apple having a nice bounce up 4.8%. This basically completes that rotation out of the bull flag pattern that we've identified. And I think I grabbed that chart to share with you in a few moments. SpaceX continuing to finish the week strong, continuing to bounce off of that opening day range. But there were some stocks that were down quite a bit today. Let's actually just do this. On the downside, you've got Tesla down 7.5%. Micron down 5.5%. Micron's back below $1,000 a share. And the problem is these are huge percentage swings on a name like Micron. Meta Platforms down 5%. I almost said 0.5%. That's a big 5%, 500 basis points down for Meta. We're going to get to the heat map in a minute, but let's talk about Micron, right? So when we've talked about the chart of Micron, here's how we've set the table for Q3, right? Sort of last week's in June, we're talking about, look, this is a chart going up. So all else being equal, it's an uptrend. Higher highs and higher lows above all the moving averages. Momentum pretty good, certainly at the beginning of June. Late June, still a great trend. Moving averages still sloping higher. Relative performance still exemplary, but much weaker momentum, right? Overbought in late May, early June, not so overbought in late June. So starting to be a momentum divergence, which is usually a leading indicator for a significant top. Now we finish the week having to report to you, we closed below the 21-day exponential moving average for the first time since the March market low. This is a stock that's been trading above all the moving averages pretty consistently. Is this mean it's the end of the great bull market in Micron? I don't see enough on this chart to make that sort of declaration. For me, like getting below the 50-day, getting below that swing low from June, I think it would be pretty important. So 850, kind of a really important level for Micron. Having said that, this is a huge move from 1250 down to 975 in about a week, right? So these are huge haircuts. Even though this looks like a little flip, this is a big percentage swing. This is the problem with a lot of the charts like Micron that have just been in these accelerated uptrends for so long. We've become kind of numb to the fact that they actually can go down. And the problem when they've gone up exponentially is they also come down, and it can be equally as painful. And so now you're seeing that with the chart of Micron. So from a technical perspective, the chart is still good. It's not great anymore, because great would be making new highs above moving averages, strong momentum. It's not great. It's still good. It's still okay, because we've not broken through a major moving average yet. The RSI is still around 50, so it's not horrible yet. But this is where I think you need to start thinking of the chart of Micron and think what would need to happen before you would start to lighten up. So for me, I don't have a position directly in Micron. I own ETFs that own Micron. I'm quite sure of that. Having said that, how would I trade something like this? The 21-day EMA is usually like an initial stop for me. I remember talking with Carter Worth earlier this week. That also should be out to you here in the next couple days. Carter Worth is a great technical analyst with amazing experience in the industry, and he talks about, look, in my personal account, I think of it in thirds. We hit my initial stop, I take a third off. We hit the second stop, I'm 2/3 out. We hit the third one, I'm 100% out. And just thinking about strategies for how to treat those different thirds. And like for me, I don't do exactly that, but using like the 21-day EMA as an initial third, that makes sense, right? It's like if we've broken that, let me just take a little bit off just to recognize the fact that we're not going up anymore and just start to unwind that position just in case this is the beginning of something more significant. So depending on the methodology you use for stops, we might have started to trigger some of those. And that means you have to start watching Micron in terms of risk management, right? All right, we'll continue on looking at the heat map. We're live streaming on Facebook, LinkedIn, YouTube, and X. Thank you, all of you, for tuning in a little bit later than expected. I apologize. I could have done much better at telling you about the late kickoff. I will try to get better at that, but I just had to focus where I had to focus today. With that in mind, though, please keep your questions coming. And if you're watching the show later on YouTube, hey, use the comments section. We would love to hear from you and hope to feature your question in our all mailbag episode tomorrow on Friday, July 3rd. Here's what the heat map looks like, right? And I don't know about you, but this is actually a pretty good day in terms of heat map. Now, the problem is the upper left corner is technology. And the problem is that's over 40% of the S&P is just that one sector. So that's a big bunch of stocks that are down pretty heavily today. And this is what is really weighing on certainly the NASDAQ, but also the S&P as well. And this is why the S&P was not up, even though financials and healthcare and consumer staples and utilities and materials all had pretty good day. I mean, not just like not so bad days, like, decent days. And a number of these have been struggling, right? The big box retailers, Walmart and Costco, have all been pulling back. They all kind of bounce higher today. Too early to say Costco is a great chart again, but showing an initial bounce, something to watch for. We've been talking a lot about the healthcare sector and some of the improvement we've seen in a lot of charts, a lot of trend lines that you might have drawn on a chart like Gilead, right? As the stock's going down, like I have no problem with you drawing a big trend line like this and saying, look, the stock's going down. Right. And I can see that by the fact that there's a bunch of different ways we could draw that trend line. Right. So it's like we've been making lower highs consistently. This feels different, right? We're back above whatever trend line you want to draw. We're probably at or just above it. We've broken back above the 200-day. We've broken back above the 50-day. So things are happening, right, with some of these names that have been down a bit. The RSI is right at 60, really close to a breakout. So I would say in healthcare, there have been some charts that have been quite strong. They've resumed their uptrends. There have been charts that have not been participating as much. They're actually breaking out as well. And some of the biggest names, Johnny John, AbbVie, all making new 52-week highs today. So plenty of strength in healthcare. I mean, I would say plenty of strength in the financial sector as well. We talked about AJ Gallagher. That had another really good day today, up another 5% after that breakout. And this is why we scan for stocks making new 3-month highs. That one in particular is a scan that I run looking for stocks making new 3-month highs, but also have a fairly low scooter ranking. So it's stocks that are not in good primary uptrends yet, have probably been going down, but are just starting to rotate. It's usually an interesting group of stocks to watch. That's where AJG came up on my radar. Like Robinhood is in a nice uptrend in June and continuing to make higher highs and higher lows. I think the charts of Visa and MasterCard are pretty impressive. I grabbed both of those to review in a few moments here in our chart review. So obviously plenty of things doing quite well. And I would say what's interesting about this market is even though the benchmarks were flat, there were a bunch of stocks that are improving. There are a number of charts that I would argue in any environment, pretty attractive, good technical configurations. It's just the names that are down are big names and they're down a lot, right? So let's focus now on all the red. Now, outside of technology, Caterpillar, which is a bit of an AI play these days, is down 2.8%. Meta down 5% after the big spike when they said they're now getting into cloud computing. Again, apparently that's not gonna completely turn that into a rocket ship, I guess, pun intended. But Meta down another 5% after a nice rally earlier in the week. Tesla rotating lower after a nice bounce to 425. But the cluster of down days was really in the technology sector. And a lot of the names that are down quite a bit today are in that semiconductor group. That semiconductor group has obviously looked so good for so long. And if you listen to the Market Misbehavior podcast, which you all should do, I ask pretty much everyone some version of the question of what do you do with the big growthy leadership that's continued to look so strong? How do you think of semiconductors here? Something like that. And, most of them sort of have this balance of the trend is strong, which I agree, right? The trends have been so positive in names like Micron. So whether you think AI is a bubble or not, like you can't deny the fact that the trends have been remarkably strong. That's true. That's fact. They're also incredibly overvalued and or overextended by many different definitions. And I know that's debatable too, but I would say clearly we are valuing these companies aggressively high relative to their earnings, but especially to the incredible amount that they're investing in AI today for profits down the road. And I think that is questionable in terms of how much we're paying now for those future earnings. And as a result, we're seeing this week that there can be very much a risk-off move in these growth areas of the market. What's encouraging about the heat map today is if the whole heat map's red, that tells you investors are panicking and they're rotating out and going into gold or bonds or some other alternative asset or something like that, or cash, or just getting away from equities. I'm seeing plenty of technology stocks down heavily, but I'm seeing plenty of other things up a ton. So this feels to me more like as the week has progressed, investors kind of going back to the lighten up and growth, add to cyclical leadership, add to defensive areas of the market. That could set the table for some corrective move here in Q3, maybe going into a major fall low. That would certainly follow the seasonal patterns pretty well if that would happen. But I think the encouraging news right now for the bulls out there is the fact that plenty of stocks were up today, right? It wasn't like everything was down. When everything's down, that's when you want to start to get nervous. When some things are down, but a lot of things are up, I wouldn't get too nervous just yet. That tells you it's just a leadership rotation, which is what I think we're definitely observing here as well. All right, we're going to continue on in a moment. I do want to give a shout out to one of my partners, Seeking Alpha. They've been longtime supporters of Market Misbehavior. They are doing their summer sale this week. You can go to marketmisbehavior.com/SA bundle. That stands for Seeking Alpha Bundle. With that, you'll get 25% off a new account. You'll get access to Seeking Alpha Premium, which is access to all of their member research, access to their quant model, their scanning tools, a lot of good portfolio analytics as well, but also Alpha Picks. They actually just released their latest Alpha Pick twice a month. They identify one particular stock that scores well in their quantitative methodology that they dig into a little deeper. I'm going to have Steve Kress, the head of the quant team at Seeking Alpha, on the podcast later in July. In the meantime, go to marketmisbehavior.com/SA bundle for more info on this bundle. It's a really good time given their summer sale with 25% off. And thanks again to my friends at Seeking Alpha supporting Market Misbehavior. Much appreciated. All right, shall we look at some charts to finish off today's show? Let's do it. The S&P 500 trading just above the upper boundary of this consolidation pattern. We're labeling this a coil or symmetrical triangle pattern. I just wrote an article earlier today for stockcharts.com, digging into this pattern in a little more detail if you want to check that out in the free portion of Stock Charts in the articles section. But again, at this point, I think this is neutral, right? This is a clear consolidation pattern of lower highs and lower lows. At this point, we want to see which way this pattern breaks. Earlier today, we actually traded above the upper boundary. That was in the afternoon or early morning as we kind of opened up, traded lower, looked like we might close above there. But then as the day progressed, it seemed more clear we are likely going to remain within the pattern, which is where we finished. So we've basically confirmed the upper trend line, the lower trend line. Now we just need to wait to see which way this breaks. And I would say on top of that, we also want to focus on the RSI, right? A break above the upper trend line, RSI needs to push above 60 to kind of validate stronger upside momentum. If the price would break through the lower boundary, RSI below 40 would confirm strong negative momentum. Anything in the middle, still kind of neutral. And that's what we're seeing here to go into the holiday weekend. So, I mean, I would say at this moment, This is one of those Jesse Livermore times, right? There's time to go long, time to go short, and time to go fishing. This has been a time to go fishing month on the S&P, right? And then, again, plenty of great opportunities at the stock and sector level, I would argue, as we've tried to document. But at the index level, it's just not been a great place because of this rotation. This rotation away from growth and into value in different forms has basically netted out to the major indexes being relatively flat while there's a lot of movement underneath the hood. Now, the strength that we saw through the course of the week did push our short-term market trend model back bullish. So going into the holiday weekend, we're back to bullish on all time frames, long-term, medium-term, and short-term. For my market misbehavior premium members, if you're watching, have no fear. We'll talk more about that reversal in the short-term model, what I think that means for the short-term versus the long-term trend. But worth noting that this bounce was enough to alleviate the bearish sign that we had last Friday after the close. If you look at today's session, one stock out of 500 in the S&P 500 made a new 52-week low today. Just one, right? That is a relatively small percentage, as I'm sure you probably know. 54%, over 10% of the S&P 500 members made new 52-week highs today. So we're not seeing any new 52-week lows. We are seeing a decent and improving number of stocks making new 52-week highs. For now, this is, the breadth is much stronger than the indexes would suggest. Indicators like percent of stocks making new highs or bullish percent index or stocks above key moving averages, all looking better and better, which speaks to how individual stocks are doing just fine. It's the index level and really the large cap growth trade that's struggling right now. As going into the weekend, we've got 68% of the S&P 500 stocks finishing the week above their 200-day. That's a great number. 67% above their 50-day moving average. Those are both pretty strong on the bullish side of the ledger. This indicator never gets much above 70%. If you look back at the last year and a half, we've never really gotten above 70%. We're pretty close to that. So, would you ever get to 100% of stocks above their 200-day? Probably not. We're getting up to the upper end of where that kind of feels like the natural limit of how many stocks would probably be above their 200-day at any given point in the cycle. Not that that's a hard and fast resistance, but just more an observation looking back over time. All right, to finish off here, let's look at some sentiment indicators. Thursday is when we check in on sentiment indicators like the AAII survey. Wanted to tell you last week, we were over 40%, getting close to 50%, which for me is a really important level to watch because anything over 50% means we're just too bullish as a group of individual investors in this survey. I actually don't participate in the AAII survey, but it's a group of individual investors. And this week, getting much lower, actually going from 43% down to 31%, bears increasing to 42%. So the last week, big shift from about 10% more bulls than bears to now over 10% bears than bulls. So that is a big switch in sentiment just from last week to this week. And some individual investors getting rattled, I would assume, given the choppiness that we're seeing in semiconductors would be my guess. Looking at the name exposure index, also a big haircut here. We were almost to 100% last week. We're down to 85%. So money managers in the survey really lightening up. At least that's what they're voting in the survey. Still overweight equities at 85%, but a lot less overweight than they were last week. Now, what else has changed? So gold's starting to pop higher. I did see a question here earlier. Are we bullish on GLD again? I mean, so for me, no. I would say the GLD, right, clear. It's like, are you bearish on Micron? Like, I'm not at this point in terms of the trend because the trend is still going up. We're still making higher highs and higher lows. Are we breaking some initial support? We are. Is it enough to make me say I think it's clear that Micron is now in a downtrend? Like, no, there's no way you could call what's happening right now as a downtrend at this point. But this could be the beginning of that for sure. This is why we need to keep watching the chart. With gold, nice bounce off of $4,000 an ounce. Clearly, that's some sort of floor for gold, similar to our line in the sand for the S&P, right? They've got those levels where we're identifying some potential support, and for now, it's holding. Nice bounce today, nice up day in both gold and silver. Does it change the trend yet? By my read, it does not. We're still making lower highs and lower lows. 4,000, though, seems to be an important level of support. once again validated there. Also noting the weakness in the dollar is a big shift here going into the weekend. We had the dollar kind of strengthening through the course of the week. Big rotation lower there. Bitcoin, while the dollar is weakening, Bitcoin having a nice bounce. Again, the chart of Bitcoin is not a great chart yet. It's still a pretty bad chart below all the moving averages, which are sloping downwards. We've been talking about this bullish momentum divergence, which we detected in the month of June. So a day like today certainly appears to, maybe at least initially be validating that thesis. So I would need to see more upside to believe that Bitcoin's in a new uptrend, but something to note. Someone had sent me this chart. I believe it's one of my premium members had sent this about the QQQ versus gold. No, you know what it was? It was a comment on our YouTube channel. And thanks for whoever sent this in. It was a great comment just talking about, and what you mentioned was I watched the ratio of QQQ, or you said the NASDAQ versus gold, and looking at the 17-day rate of change. Now, this is not my idea. This is your suggestion. I appreciate you sharing it. So I set this up as a chart and wanted to share it with you guys. So what's happened is, the comment was when the QQQ versus GLD, and this is my interpretation of his comment looking at the NASDAQ versus gold, when the 17-day rate of change goes negative, that tells us we need to be owning gold because now, basically the NASDAQ's underperforming gold. That's the time to rotate into that asset. And if you look back, that's been a pretty good indication, right? Because this ratio going down means gold is outperforming. So when it gets below that 17-day rate of change, that's when it's really started to accelerate many times to the downside. So not quite getting there, but something I'll certainly be watching here going into the beginning of next week. But I would say what this represents is also pretty important. This is actually similar to another ratio I look at all the time and have for some time, which is looking at the S&P versus gold. So what you're doing here is basically looking at the S&P in gold terms, and when that happens, you can see same thing. We see that the S&P has been outperforming gold here in the second quarter. First quarter was, really more gold versus the S&P. Second quarter, the ratio is just ripping to the upside. The ratio is overbought for a while, just starting to come off a little bit. And so that ratio turning lower. And again, I like that idea of a 17-day rate of change. That'll give you basically enough of a turn to kind of signal that reversal, something to watch. But what this means is you're basically looking at stocks in terms of hard assets, in terms of instead of the S&P in terms of dollars, it's like the S&P in terms of gold. And I think that's an interesting way to think about the real value of your S&P 500 investment or the index itself. Great chart, by the way. And thanks for sharing that on our YouTube comment section. Apple validating a bullish breakout yesterday. We talked about this push above the upper boundary of this bull flag pattern today. Strong follow through day, powering back above $300 a share. I think Apple's a great setup here compared to most of the Magnificent Seven. That's probably the best I would say technical setup that I see across that basket of stocks at this particular moment. Paychex is another one that came on my list. Made the new three-month highs list today, back above the 200-day moving average for the first time since July of 2025. We talked about this chart as having a nice bounce, but can it get above the 200-day? And today it definitely did. So strong finish, and I would argue a strong upside rotation in that name. Visa really accelerating here in the last couple of weeks, just getting above those early 2026 highs. So finally making a new high for 2026. Overbought, which for me just means it's up a lot. Not necessarily a negative thing, but something certainly to watch for a short-term pullback of sorts after this acceleration to the upside. But both Visa and then MasterCard overbought with some strong movements. MasterCard, on the other hand, back above the 200-day for the first time since January. So a nice upside reversal. I think both, a lot of the areas of the financial sector look interesting, but this is where we're seeing some real improved returns here just in the last couple weeks, something to acknowledge. All right, let's take a question or two, and then we'll wrap it up here. Larry, you asked target 323 for the flag. I think you're talking about the Apple flag. Let's go back here. So, I see what you're saying. Yeah, so there's a couple different ways to think about this. You'd said 323, which would basically be just above these levels. So the generally accepted methodology would be if this is a flag pattern, you take the flagpole, which is basically the last major low up to that pattern, and you would project that from the high. So that actually, if you think about this distance and projecting it up here, that's like up by the trash can icon. So that's, up to like 350, 360 would be my just kind of quick. I'd have to use a different chart to really give you a more precise measurement, but that's the generally accepted way to measure it, is taking the height of the flagpole, the trend going into the pattern, and projecting that same move in terms of time and price duration from the breakout level. So copy this line here and add it to there. That'll give you an objective somewhere up by that trash can, which is up a decent amount. That's one way to use that. That's the way you would use the flag pattern to project an upside target on Apple, which is why I was saying the breakout of that bull flag pattern is actually a really good sign, and that's exactly why, because of the measuring technique that we usually use for that. Jim, thank you for watching. You said, Dave, do you use the 21-day EMA for ETFs as well for taking chips off the table? And the answer is yeah. I mean, I for stocks and ETFs, generally speaking, I tend to think of that. I think of those as similar. I think of ETFs as just like an equity-like product, which is what's so attractive about it, but is obviously representing a group of things, most often equities, but other times other asset classes and maybe derivatives as well. But yeah, the 21-day EMA for me is a general kind of initial stop when I'm thinking of something that's been going up. And that's one of the challenges, right? When you have a stock, I mean, great problem to have. We have a position that's been going so well, it keeps going vertical. So what do I do? And hopefully the answer is you hold on as long as possible. As long as the chart keeps telling you it deserves a place in your portfolio, hopefully you still follow it. But having something in your toolkit that's like that initial break, where you don't sell everything, you don't just like blindly chop the position off, but you just trim a little bit, right? Just to recognize, okay, we've started to show enough weakness that I want to take some off. And someone shared a version of what I feel is like my favorite quote ever. And there were a couple people that shared this, but I want to say, and I don't know who all to attribute this to, but Todd Harrison is the guy that comes to mind on this quote. Todd Harrison ran a website called Minionville. This is back in like the early mid 2000s, way ahead of its time. It was a website that was like a financial education and market commentary site. They had a little chat room, which is like before Discord was thing. It was like an AOL kind of style chat built into the website, and all these the different characters. So like there was a cartoon bull and a cartoon bear and a cartoon snake, and they would like have discussions of the market. I mean, it was a really clever website, but he was a fantastic trader and just great market insights. And he once shared, "All large losses begin as small losses," was the quote I think he shared. Ned Davis has a version of that quote that he would share as well, that I remember him bringing up in a meeting years ago. But I think that's a really cool way of thinking about it, right? That initial stop just prevents you from just having a huge loss when you could just make it a small loss. And part of the way that you do that is by lightening up when you start to see those initial signs. And I think that initial stop is so helpful, because what it does is it gives you the confidence to acknowledge that it might not work, right? Like, okay, something might be wrong here on the chart of Micron. And maybe it turns tomorrow and goes up. That's great. But for me, I like protecting against climactic loss, and something like that, where you're at least taking a little bit off, that just says, okay, I'm now acknowledging that this might be a problem that I want to focus on. And by taking that initial stop, I found I focus a lot more on sticking to the discipline of unwinding if we hit further stops. For me, that first step is absolutely crucial. Folks, I hope you enjoyed this discussion of the current market environment with some random education and a story or two peppered in there. Thanks so much for tuning in live. Those of you doing so, always a pleasure to be looking at charts with you folks. Have a fantastic day off from the markets. We will be back tomorrow with an all mailbag episode, so I hope you can check it out. There's always a lot of fun to answer some of your questions with a little more time and space. We will have 2 episodes of the Market Misbehavior podcast between now and next Monday. So keep an eye on our YouTube channel, and also anywhere where you get podcasts. Check out the Market Misbehavior podcast. 2 good discussions coming your way here very soon. Have a great night. I'm Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts. Take care, folks.